in terms of where the FOMC goes next, the expectation, of course, is very much that the Fed will hike this week.
Yes.
So you're not so much interested in the move itself because it's been talked about.
Yep.
You know, endlessly over recent months, but you are interested in the changes in the economic and interest rate projections that we could get from the Fed. So I pulled up Dots Go on the Bloomberg, and this shows you the expectations or the estimates from various Fed officials as to where rates go next. And you think that's where we could get some movement then this week?
That's absolutely correct. We know we're going to get a hike from the Fed. So the issue is the extent to which they upgrade their economic projections and consequently therefore start shifting these dots. And even before any prospect of tax cuts, the US economy clearly has strong momentum and actually accelerating into the latter part of the year. I mean, it's currently growing at sort of 3+% on an annualized basis. So even without the potential for tax cuts, the Fed was going to be raising its projections, dropping for growth and dropping its projections for unemployment. Now, as part of that, do you think that there's a non-negligible chance that the Fed will, at this meeting, or the FOMC members, will actually raise their dots? And it only takes 3 members to sort of say, well, faster growth, lower unemployment means that interest rates should be somewhat higher going forward, for us to actually go from, say, 3 rate hikes projected for 2018 to 4 rate hikes. Right now, the Fed is also only projecting 2 rate hikes for 2019. I think that could easily be pushed up to 3.
Pushed up to 3. So if they get a little bit more aggressive, do you want to join the shorter end of the yield curve? I mean, you're looking at what, 2-year yield just under 1.8%. I'm looking at what Rick Ryder's doing. BlackRock is buying the bonds that are most at risk of added Fed hikes. Is that the strategy that goes with that thinking if you get that shift in the dots?
Well, the strategy that we have adopted in terms of our view around the Fed is that the market is still underpricing the path of short-term rates, and that there's a skew to higher rather than disappointment relative to those expectations. So we actually have a short position across a number of our strategies expressed in terms of the short end of the US curve. So we're looking to enhance and benefit our portfolios if indeed the dots do move higher. And more significantly, of course, is that if actually interest rates at the short end do also move higher. We've also been, though, having a sort of flattening of the curve is something which we positioned for across a lot of our credit strategies. Most of our credit assets probably have a duration of around sort of 4 to sort of 6 years, and actually the flattening of the curve has actually been perfectly fine for them. It means that they've not really faced a duration headwind. And then we've had a short position at the short end. And that's still how we're broadly positioned.
David, I pulled up this chart. This is what JP Morgan is looking at the moment. So many are focused on the yield curve and whether this is giving us a clue as to where in the cycle we are. Are we near the end of the cycle? But this is what JP Morgan are looking at the moment. They say the inflection is actually around real Fed rates. And they say when that gets to 1%, we're currently at minus 0.5%, aren't we? When that gets to 1%, that's when they start to see late cycle. Do you share that view? Is that the clue to late cycle, or are we late cycle already?
I don't think we are actually late cycle. It's just a very long cycle, but it's a pretty much an exciting cycle from a sort of macroeconomic point of view. And you're absolutely right that when you actually look at the Fed funds rate and where rates are right now, it's still actually very accommodative. It's still actually loose, essentially. So with an economy growing above 3%, unemployment going to be dropping below 4%. And OK, yeah, we've certainly not had much in the way of wage or inflation pressure, but it's starting to pick up. So I think that's where we're headed, to positive real rates.